I have survived 13 recessions in my lifetime. The recession of 1953, when I was just starting out as an investor, barely into my 20s, working from a small office in Omaha with more ambition than assets. The recession of 1957 and 58 that tested my young partnership for the first time. The recession of 1960 and 61. The brutal stagflation recession of 1969 and 70 that confounded economists and investors alike. The devastating downturn of 1973 and 74 when stocks lost nearly half their value and investors abandoned equities for a generation. The double-dip recessions of 1980 and 1981 through 82 when interest rates hit 20% and businesses across America shuttered their doors. The recession of 1990 and 91. The dot-com collapse of 2000 and 2001 when trillions of dollars in supposed wealth evaporated overnight. The Great Recession of 2008 and 2009 that nearly broke the entire global financial system and brought us closer to complete economic collapse than any event since the Great Depression. And the brief but sharp pandemic recession of 2020 that took everyone by surprise. 13 recessions, each one different in its causes and characteristics, each one terrifying while it was happening, each one proclaimed by someone, somewhere, to be the end of capitalism, the end of prosperity, the end of the American economic miracle. And each one an extraordinary opportunity for those who kept their heads in their nerve. I am 94 years old now. I have been investing for more than 75 years. I bought my first stock when I was 11 years old, and I have been studying markets and businesses every day since then. I have made countless mistakes, learned painful lessons, and gradually developed a philosophy that has served me through every kind of market environment imaginable. I am stepping down as CEO of Berkshire Hathaway at the end of this year, handing the reins to Greg Abel, whom I trust completely to carry forward our philosophy and our culture. But I remain chairman of the board, I remain the largest shareholder, and I remain deeply engaged in thinking about what lies ahead for investors and for the companies we own. And what lies ahead concerns me, not in a way that makes me pessimistic about the long-term future of American business. Let me be absolutely clear about that. I remain as optimistic as I have ever been about the trajectory of American enterprise over the coming decades. American companies will continue to innovate, to grow, to adapt, and to reward shareholders who think in terms of decades rather than quarters. That trajectory has been remarkably consistent throughout my lifetime and will continue long after I am gone. But the path to that bright future will include some dark moments along the way. It always does. And I believe we may be approaching one of those dark moments. At our annual shareholders meeting earlier this year, I told the crowd in Omaha that they should expect a period in the next 20 years that will be a hair curler compared to anything we have experienced before. Some people thought I was being dramatic. Some thought I was trying to scare them. Some probably dismissed it as the ramblings of an old man who has lived through too many crises. But I was not trying to frighten anyone. I was simply stating what history tells us is inevitable. The stock market has never gone 20 years without experiencing a decline of at least 20% from its peak. Never. Not once in all of recorded financial history. In the 75 years since I bought my first stock, we have experienced 9 such declines of 20% or more. That is roughly 1 every 8 years on average. The last truly severe market decline ended in early 2009, more than 16 years ago now. The pandemic crash of 2020 was sharp but incredibly brief, recovering within just a few months. We are overdue for a significant correction by any historical standard you care to apply. I do not know when it will come. I do not know what will trigger it. I cannot predict the timing or the severity with any precision, and I have never claimed to possess such abilities, but I know it will come. That is not pessimism or fear-mongering. That is simply reading the historical record, honestly and without illusion. And so my strategy for 2026 and beyond is built around this certainty. Not the certainty of when or how much or what will cause it, but the certainty that significant volatility lies ahead and that those who prepare for it will be rewarded while those who ignore it will suffer. Let me share that strategy with you in detail. The first and most important element of my 2020 Sixth strategy is maintaining the largest cash position in Berkshire Hathaway's history. As of our last filing, we hold over $380 billion in cash and treasury bills. That is not a typo. $380 billion sitting in short-term government securities, earning modest interest, waiting. Some people think this is too much cash. They write articles criticizing me for being too conservative. They say we should be putting that money to work that we are earning only 4 or 5% on treasury bills when we could be generating higher returns in equities. They calculate the opportunity cost and declare it a waste. I understand that criticism, but I reject it entirely. This cash is not sitting idle because I lack ideas or because I have become too conservative in my old age. I still study balance sheets every day. I still read annual reports with enthusiasm. I still get excited when I find a business I want to own. This cash is not a symptom of laziness or declining mental acuity. This cash is ammunition. It is preparation for the opportunities that will emerge when fear dominates markets and prices collapse and everyone else is scrambling for survival. Throughout my career, spanning more than 6 decades of active investing, the best investments I have ever made came during periods of maximum fear and uncertainty. When others were selling in panic, dumping stocks at any price just to get out, I was buying the best businesses in America at prices that seemed absurd in retrospect. But to buy during those periods, you need cash. You cannot take advantage of a crisis if you are fully invested when it arrives. Let me give you some specific examples of what I mean. In September of 2008, the financial system was on the brink of complete collapse. Lehman Brothers had just failed. AIG was being bailed out. Credit markets were frozen solid. Nobody would lend to anybody. Fear was as intense as anything I had ever witnessed in my career. And that is when I called Goldman Sachs. Goldman was one of the most storied names on Wall Street. But in that moment of panic, even Goldman needed capital to reassure markets and counterparties. So I offered him $5 billion for preferred shares that paid a 10% dividend, plus warrants to buy common stock at favorable prices. Some people thought I was crazy. Why invest in a financial firm when the financial system was collapsing? But I knew Goldman was not going anywhere. The brand, the talent, the client relationships, the government's determination to prevent systemic failure, all of these factors meant Goldman would survive and eventually thrive. That single investment generated billions of dollars in profit for Berkshire shareholders. The preferred shares paid us $500 million a year in dividends. The warrants allowed us to buy shares well below market prices when Goldman recovered. But here is the crucial point. I could only make that investment because we had the cash available. While other investors were selling to meet margin calls, while institutions were liquidating to meet redemptions, while banks were hoarding every dollar they could find, Berkshire had the resources to act. We did the same thing with General Electric, another iconic American company that needed capital during the crisis. We did it with Bank of America a few years later, investing $5 billion that eventually turned into a position worth over $20 billion. Those opportunities only existed because we had the resources to act when others could not. The investors who were fully invested could not buy anything. Many were forced to sell at the worst possible prices just to survive. They became the victims of the crisis rather than its beneficiaries. I intend to be a beneficiary of whatever comes next, not a victim. That requires patience now. It requires accepting lower returns on cash while we wait for better opportunities. It requires the discipline to resist the pressure from analysts and commentators to put money to work just because it is available. Charlie Munger, my partner for more than 60 years, used to say that the big money is not in the buying and selling, but in the waiting. I miss Charlie every day, but his wisdom remains with me. The big money comes from having the patience to wait for great opportunities and the resources to act decisively when they arrive. $380 billion of dry powder is my answer to whatever the market throws at us in 2026 and beyond. The second element of my strategy is reducing exposure to positions that have become overvalued relative to their intrinsic worth. Over the past year and a half, we have sold significant portions of our holdings in Apple and Bank of America. These are wonderful companies. Apple in particular has been one of the best investments in Berkshire's history. We paid an average of about $35 per share for a position that we still hold, and that has generated enormous value for our shareholders. But valuations matter. Even great companies can become overpriced. When stock prices rise far faster than underlying business value, the expected returns from holding those stocks decline. At some point, the risk-reward calculation changes. I learned this lesson painfully early in my career. In the late 1960s and early 1970s, there was a group of stocks called the Nifty 50. These were supposedly the greatest companies in America. Companies so wonderful that you could pay any price for them and still do well over time. Coca-Cola, IBM, Xerox, Polaroid, and dozens of others were included in this group. Investors bid these stocks up to extraordinary valuations. Price-to-earnings ratios of 50, 60, 70 times earnings were common. The logic was that these were permanent franchises that would grow forever, so any price was justified. That logic proved catastrophically wrong. When the 1973 and 74 bear market arrived, many of these stocks fell 50, 60, even 80% or more. Some, like Polaroid and Xerox, never recovered their former glory. Investors who paid those high prices waited decades just to break even, if they ever did. The lesson was seared into my memory. Price matters. Valuation matters. Even wonderful businesses become poor investments if you overpay for them. I am not predicting that Apple or Bank of America will crash. They may continue rising for years. I cannot predict short-term price movements and have never claimed to possess that ability. But I can assess value, and I can recognize when prices have gotten ahead of themselves. By reducing these positions, we accomplish two important things. We lock in substantial gains from investments that have performed extraordinarily well, and we raise additional cash that can be deployed when better opportunities arise. This is not market timing in the traditional sense that Wall Street uses that term. I am not trying to sell at the exact top and buy at the exact bottom. That is a fool's game. I am simply adjusting portfolio weights based on changing valuations and opportunities. When something becomes expensive relative to its intrinsic value, I reduce it. When something becomes cheap, I increase it. That discipline has served me well for more than 60 years. The third element of my strategy is focusing on businesses that will thrive regardless of what economic conditions emerge. In recent months, we have added to our positions in companies that meet very specific criteria. Companies like Constellation Brands, the maker of Corona and Modelo beers, beverages that people enjoy in good times and bad. We have increased our stake in Chevron, the energy giant that provides products essential to modern life. We have built significant positions in home builders like Lennar that are positioned to benefit from America's persistent housing shortage. These are not speculative bets on short-term price movements or macroeconomic predictions.
These are investments in businesses with durable competitive advantages that will generate earnings for decades. They sell products that people need and want regardless of economic conditions.
They have strong balance sheets that can weather any storm. They have management teams I trust to allocate capital wisely and to treat shareholders as partners. This is the approach that has worked for me since I took over Berkshire Hathaway in 1965. Buy wonderful businesses at reasonable prices and hold them forever. Do not try to trade in and out based on predictions about the economy or the market or interest rates or any of the other factors that consume Wall Street's attention. Own pieces of great businesses and let compound interest and time work their magic. The wonderful thing about owning great businesses is that you do not need to predict recessions or market crashes to do well. If the economy is strong, great businesses earn more and become more valuable. If the economy is weak, great businesses gain market share from struggling competitors and emerge even stronger. Either way, you win. Take Coca-Cola as an example. We bought our stake beginning in 1988. Since then, we have experienced recessions, market crashes, terrorist attacks, financial crises, pandemics, and every other kind of disruption you can imagine. Through it all, Coca-Cola kept selling beverages to billions of people around the world. The dividend has increased every year. The business has grown stronger. Our initial investment of about $1.3 billion is now worth around $24 billion. And we have collected billions more in dividends along the way. That is the power of owning wonderful businesses for the long term. The fourth element of my strategy is international diversification through carefully selected opportunities. For most of my career, I focused almost exclusively on American businesses. The opportunity set was vast. I understood the culture and legal system, and I saw no need to complicate things by venturing overseas. Charlie and I often joked that there was plenty of fish in our own pond without needing to fish in distant waters. But in recent years, I have found remarkable opportunities in Japan. We have built substantial positions in 5 major Japanese trading companies: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. Our stake in these 5 companies is now worth over $23 billion, and we have received permission from each company to increase our ownership to as much as 10%. These are remarkable businesses that I wish I had discovered decades earlier. They are diversified conglomerates engaged in commodities, manufacturing, shipping, energy, food, textiles, chemicals, and dozens of other industries. They are similar to Berkshire in some ways. Collections of disparate businesses managed with a long-term perspective and a focus on creating value for shareholders over decades. When we first looked at these companies, they were available at valuations far below comparable American companies. Their dividend yields were highly attractive. Their management teams demonstrated genuine alignment with shareholders, and they provided exposure to the Asian economy without the risks associated with investing directly in mainland China. I have had wonderful meetings with the leadership of all 5 companies. They think in generations, not quarters. They value relationships and trust. They run their businesses with a conservatism and prudence that I admire deeply. I expect to hold these positions for the rest of my life. Greg Abel will continue building these relationships after I step down as CEO. The Japanese trading houses represent exactly the kind of long-term partnership I have always sought in my investments. They are keepers. We finance these purchases cleverly, in my view, by issuing yen-denominated bonds. This means we borrowed in Japanese yen at very low interest rates and used those yen to buy shares in Japanese companies that pay dividends in yen. The currency risk is naturally hedged. The cost of financing is minimal. And we own wonderful businesses that are paying us dividends that exceed our interest costs. That is the kind of investment I love. Low risk, high probability, good returns, and optionality if things go even better than expected. The fifth element of my strategy is maintaining absolute financial strength at Berkshire Hathaway, regardless of external conditions. I have always run Berkshire with extreme fiscal conservatism that some consider excessive. We never take on debt levels that could threaten our survival under any conceivable circumstances. We never make acquisitions that stretch our resources or require us to bet the company. We always maintain enough liquidity to meet any obligation without selling assets at distressed prices. This conservatism has a cost. We forgo some opportunities that would require leverage or more aggressive capital deployment. We probably earn lower returns during boom times than we would with a more aggressive approach. Investment bankers and consultants have tried for decades to convince me to use more leverage, to financial engineer higher returns. I have ignored them all. Because this conservatism has allowed us to survive and thrive through 13 recessions, while more aggressive competitors failed, it has allowed us to be buyers when everyone else was forced to sell. It has made us the phone call that companies and governments make when they need a partner with resources and stability and unquestioned ability to perform. When the financial crisis hit in 2008, banks called us, industrial companies called us, even foreign governments called us. They knew Berkshire had the resources, the credibility, and the willingness to act. That reputation took decades to build and is worth far more than any incremental returns from higher leverage. In 2026 and beyond, I expect that conservatism to prove its value once again. Whatever challenges emerge, whether recession or inflation or financial crisis or some combination we have not yet imagined, Berkshire will be positioned to handle them. We will not be forced to sell assets at distressed prices to meet obligations. We will not face margin calls or debt covenants that force our hand. We will have the flexibility to act opportunistically while others are scrambling to survive. That is worth more than any short-term performance advantage. That is what allows us to sleep well at night while owning hundreds of billions of dollars in assets. Now let me explain the reasoning behind this strategy in more detail, because I want you to understand not just what I am doing, but why I am doing it. The current market environment reminds me of several prior periods that ended badly for investors who ignored the warning signs and convinced themselves that this time was different. Valuations are stretched by almost any historical measure you choose to examine. The ratio of total stock market value to GDP, sometimes called the Buffett indicator, though I did not invent it, is near all-time highs. This ratio simply asks what the stock market is worth relative to the actual economic output of the country. When stocks are worth far more than GDP, it usually means investors are paying high prices relative to the earnings those businesses can realistically generate. The cyclically adjusted price-to-earnings ratio, the CAPE ratio, popularized by Professor Robert Shiller, is elevated well above long-term averages. This measure smooths earnings over 10 years to remove cyclical fluctuations and gives you a sense of what you are paying relative to normalized earnings. Power. Corporate profit margins are at historically high levels. This might seem like a good thing, but margins tend to mean revert over time. Competition, wage pressures, and changing economic conditions typically push margins back toward historical norms. When you are paying high multiples of peak margins, you are doubly exposed if margins decline while multiples compress. None of these indicators tell you when a correction will occur. I want to be very clear about that. Valuations can stay elevated for years before anything changes. I learned that lesson during the dot-com bubble, which persisted far longer than I expected before finally collapsing. But these indicators do tell you that expected returns from current price levels are likely to be below historical averages. They tell you that there is less margin of safety than there would be at lower valuations. They tell you to be cautious and patient rather than aggressive and impatient. At the same time, the economy faces genuine uncertainties that could trigger the kind of volatility I am preparing for. Inflation has proven stickier than many economists and Federal Reserve officials expected. After years of near-zero interest rates, we have moved to a world of positive real rates that puts pressure on asset valuations and debt burdens. Trade policies create unpredictable disruptions that are difficult for businesses to plan around. Tariffs and trade tensions can disrupt supply chains, raise costs, and create winners and losers in unpredictable ways. Geopolitical tensions add additional risks that are hard to quantify, but real nonetheless. Relations between major powers are more strained than they have been in decades. Regional conflicts could escalate in ways that disrupt energy markets, trade flows, and investor confidence. The federal deficit continues to grow, adding to a national debt that already seems unmanageable to many observers. At some point, the mathematics of debt, deficits, and interest payments will require difficult adjustments. I am not predicting recession in 2026. As I have said countless times over the decades, I have never been able to forecast recessions with any reliability, and neither has anyone else, despite their confident predictions. The economists who correctly predicted the last recession have been wrong about the subsequent 5 recessions they forecast, but the conditions are present for volatility and potential disruption. The kindling is stacked high. We do not know when or if a spark will arrive, but we know the fire risk is elevated. Against this backdrop, maintaining substantial cash reserves and reducing exposure to expensive positions seems prudent to me. It may cost us some returns if markets continue higher. That is the trade-off I am willing to make, because it positions us extraordinarily well for whatever happens next. Let me also be very clear about what I am not doing in my 2026 strategy. I am not selling everything and hiding entirely in cash and treasury bills. That would be market timing of the worst sort, and I have criticized that approach my entire career. Despite elevated valuations and economic uncertainties, I remain substantially invested in wonderful businesses. The core Berkshire portfolio remains largely intact. We continue to hold major positions in Apple, American Express, Coca-Cola, Chevron, and dozens of other quality companies. These businesses will continue generating earnings and dividends regardless of what happens in markets or the economy. I am not trying to predict the exact timing of any correction. I do not know if it will come in 2026, 2027, 2030, or some other time. I do not know if it will be triggered by recession, inflation, geopolitical crisis, financial contagion, or something nobody is currently discussing. Trying to time such events precisely is futile. Anyone who claims to know exactly when the next crash will occur is either lying or deluding themselves. I am not abandoning my long-term optimism about American business. The trajectory of American enterprise over the next 50 years will be upward, as it has been for the past 200 years. That is my strong conviction. Recessions and corrections are temporary interruptions in a permanent trend of growth, innovation, and increasing prosperity. The interruptions can be painful, but they are interruptions, not permanent impairments. I am not recommending that individual investors copy my exact approach dollar for dollar. Berkshire has unique characteristics that enable certain strategies unavailable to ordinary investors. We have insurance float that provides permanent capital at zero or even negative cost. We have wholly owned businesses generating cash regardless of what stock prices do. We have a scale that requires elephant-sized opportunities to move the needle. Individual investors should adapt these principles to their own circumstances, goals, and psychological makeup. The underlying philosophy applies universally. The specific implementation depends on your particular situation. Let me provide some specific guidance for individual investors preparing for 2026 and beyond. First, honestly assess your cash reserves. Do you have enough money set aside to meet living expenses for 6 months or ideally a full year without touching your investment portfolio? Could you handle a job loss, a medical emergency, a major home repair, or some other unexpected expense without being forced to liquidate investments at the worst possible time? If not, building those reserves should be your absolute highest priority before you invest another dollar. The peace of mind that comes from adequate cash reserves is worth far more than the modest returns you forgo by holding that cash instead of investing it. I have seen too many investors forced to sell stocks at market bottoms because they needed the money for living expenses or emergencies. They suffered permanent losses that they never recovered from. Do not let that happen to you. Second, examine your portfolio honestly for concentration risk. Are you overly dependent on a single stock, a single sector, or a single investment thesis? Could a significant decline in one area devastate your overall financial position? Diversification is protection against ignorance. I say that not as an insult, but as a recognition that even the best investors, including me, make mistakes. We misjudge businesses. We miss emerging threats. We are wrong more often than we would like to admit. Spreading your investments across multiple quality businesses in different sectors reduces the impact of any single error. I have made plenty of mistakes over the decades. I bought a department store that went nowhere. I invested in a shoe company that struggled. I purchased an airline that we eventually sold at a loss. I held Berkshire's textile business far too long out of sentiment and loyalty. None of these mistakes destroyed us because they were modest positions in a diversified portfolio of wonderful businesses. Third, stress test your portfolio in your mind. Imagine your portfolio declining 40%, 50%, or even 60%, as has happened in severe bear markets throughout history. Could you hold through that decline without panic selling? Would you be able to continue your regular investments even as paper losses mounted? Would your lifestyle be okay? Would your marriage survive? Would you sleep at night? These are not trivial questions. The worst possible outcome is holding an aggressive portfolio during good times and then selling in panic during bad times. You experience the full downside with none of the subsequent recovery. You lock in losses that become permanent. If imagining a 50% decline causes you genuine distress, your portfolio may be too aggressive for your psychological makeup. There is no shame in that. Far better to hold a more conservative portfolio that you can stick with than an aggressive portfolio you will abandon at the worst possible moment. Fourth, focus relentlessly on quality. The businesses you own should have strong balance sheets with minimal debt. They should have durable competitive advantages that protect their market position. They should have proven management teams with long track records of intelligent capital allocation. They should sell products or services that people need regardless of economic conditions. These businesses will survive and thrive through whatever economic environment emerges. They will weather recessions, adapt to changing conditions, and emerge on the other side in strong competitive positions. Weaker businesses may not survive. Every recession shakes out marginal competitors. The businesses that were barely getting by in good times fail when conditions tighten. If you own those marginal businesses, you suffer permanent losses rather than temporary markdowns. Fifth, and perhaps most importantly, commit to a specific plan before the volatility arrives. Decide now, in this calm moment, exactly how you will behave if markets decline 20%, 30%, 40%, or more. Write down your plan. Share it with a spouse or trusted friend who can hold you accountable. Will you continue your regular investment contributions regardless of market conditions? Will you increase your investments as prices fall, buying more shares at lower prices? Will you hold steady and simply wait for the storm to pass? Will you rebalance your portfolio at specific thresholds? Whatever your plan, make it specific and commit to it now, because making these decisions during a crisis is nearly impossible. Fear overwhelms rational thinking. Panic dominates. The crowd screams at you to sell and stop the pain. Every instinct you possess says to get out before things get worse. If you have a plan made during calm moments, you can execute that plan even when your emotions are running wild. The plan becomes your anchor when seas get stormy. It substitutes discipline for emotion. It keeps you on course when everything seems to be falling apart. Let me share some historical perspective that may help you maintain your equilibrium when difficult times arrive. In 1973 and 1974, the stock market fell nearly 50% from peak to trough. The Nifty 50 darlings collapsed. Investors were devastated financially and psychologically. Many believed that stocks had been permanently impaired as an investment class. Books were written declaring the death of equities. The public abandoned stocks and did not return for years. But those who held on and continued investing through that brutal period experienced the greatest bull market in history during the 1980s and 1990s. The pain was very real, but completely temporary. The gains that followed were extraordinary beyond anything the bears imagined. An investor who put $10,000 into a diversified stock portfolio in January 1974 and held on would have seen that investment grow to more than $500,000 by 1999. The worst possible starting point became the best possible starting point for patient investors. In 2008 and 2009, the financial system came closer to complete collapse than at any time since the Great Depression. Major banks failed or were rescued. Lehman Brothers went bankrupt. AIG required a government bailout. Credit markets froze completely. Unemployment soared. House prices crashed. Retirement accounts were devastated. The stock market fell more than 50% from its peak. Investors who panicked and sold locked in devastating losses. Some never returned to the market, missing the entire recovery. Others sold at the bottom and bought back at much higher prices, permanently impairing their wealth. But those who held on and continued investing recovered within a few years and went on to earn substantial returns during the bull market that followed. The S&P 500 went on to gain more than 700% from its 2009 low. An investor who kept investing through the crisis accumulated wealth that transformed their financial lives. In March of 2020, the pandemic crashed stocks more than 30% in just a few weeks. Fear was overwhelming and completely understandable. Nobody knew how long lockdowns would last, how deadly the virus would prove, or how severe the economic damage would become. Businesses shuttered. Unemployment claims soared. The future was genuinely uncertain. Those who sold at the bottom missed one of the fastest and most powerful recoveries in market history. Within months, stocks had recovered their losses and gone on to new highs. The fear that seemed so justified in March looked foolish by December. The pattern is remarkably consistent across all these episodes. Fear creates opportunity for those brave enough to act on it. Panic creates losses for those who give in to it. Patience creates wealth for those who possess it. I have no special insight into what will happen in 2026 or 2027 or the years beyond. I cannot tell you whether stocks will be higher or lower a year from now. I cannot predict the timing or severity or trigger of the next correction. I have never possessed that ability, and I am suspicious of anyone who claims to. But I can tell you with absolute confidence, born of 75 years of experience, that corrections will come. Fear will dominate at some point. Prices will become attractive for those with cash and courage to act. My strategy for 2026 is designed to be ready for that moment, whenever it arrives. Substantial cash reserves to deploy when prices fall, reduced exposure to positions that have become expensive, continued ownership of quality businesses that will thrive regardless of conditions, international diversification through carefully selected opportunities, absolute financial strength that allows us to survive any storm and seize any opportunity. These elements position Berkshire Hathaway to thrive regardless of what economic and market conditions emerge in 2026 and beyond. They position us to be buyers when everyone else is forced to sell. They position us to take advantage of fear rather than succumb to it. You can apply the same principles to your own situation. Maintain adequate reserves. Own quality businesses. Diversify appropriately across sectors and geographies. Make a plan before you need it. Think in decades, not days. That is the accumulated wisdom of 13 recessions and 75 years of investing distilled into a strategy for the uncertain. Years ahead, I am not afraid of what comes next. I have seen far worse and survived. I have seen fear create extraordinary opportunities for those prepared to act. I have seen patience rewarded beyond anything the panic sellers imagined possible. Whatever happens in 2026 or the years that follow, Berkshire will be ready. I hope you will be too. Greg Abel will take over as CEO on January 1st of 2026. He shares my philosophy completely. He understands that Berkshire's strength comes from patience, discipline, and long-term thinking. He will maintain the fortress balance sheet that has served us through 13 recessions. He will deploy capital only when opportunities meet our rigorous standards. He will be ready for whatever the future brings. I will remain as chairman, offering advice when Greg asks for it, but trusting him completely to lead the company. My stake in Berkshire remains my largest holding by a wide margin. My commitment to shareholders remains absolute. My confidence in the long-term future of American business remains unshaken after 9 decades of observation. But I am realistic about what the path to that brilliant future may include. The next 20 years will bring challenges that test investors severely. There will be periods of fear and despair that make 2008 look mild by comparison. There will be moments when it genuinely feels like the world is ending and prosperity is gone forever. It will not be ending. It never is. America and American business will overcome whatever challenges emerge, as they always have throughout our history. The businesses that comprise our portfolio will continue serving customers, generating profits, and rewarding shareholders through good times and bad. But navigating from here to there will require the same qualities that have served me through 13 prior recessions. Patience to wait for the right opportunities. Discipline to stick to your plan when emotions scream at you to abandon it. Courage to act when others are paralyzed by fear. Willingness to hold through volatility without losing your nerve. Focus on long-term business value rather than short-term price quotations. That is my strategy for 2026. Not a prediction of exactly what will happen, but a preparation for whatever does happen. Not a guarantee of specific returns, but a positioning for opportunity. Not fear of the future, but appropriate respect for its inherent uncertainty. Before I close, let me share some specific lessons from the 13 recessions I have survived that may help guide your own preparation. The recession of 1953 taught me that downturns can come suddenly and without much warning. The economy had been humming along after the war. Optimism was everywhere. Then inventory corrections and reduced government spending after the Korean War armistice triggered a sharp but brief recession. The stock market fell about 13%. I was just 23 years old, running a small investment partnership. I had very little capital, but enormous enthusiasm. That recession taught me to always maintain reserves, to never be fully invested with no cushion for unexpected developments. The recession of 1957 and 58 was more severe. The market fell about 20%. This one was caused by tight monetary policy from the Federal Reserve, which was trying to combat inflation. Credit became scarce. Businesses pulled back. Unemployment rose. What I learned from that recession was the importance of owning businesses that could survive credit crunches. Companies with strong balance sheets and low debt survived intact. Companies that depended on constant refinancing struggled or failed. That lesson has shaped my preference for fortress balance sheets ever since. The recession of 1960 and 61 coincided with John Kennedy taking office. It was relatively mild, with unemployment rising, but not catastrophically. What I remember most from that period was how quickly sentiment could shift from pessimism to optimism once people saw light at the end of the tunnel. Markets often begin recovering well before the economy does. By the time economic statistics confirm recovery, stock prices have already moved substantially higher. This reinforced my belief that you cannot wait for certainty before investing. If you wait for the all-clear signal, you miss the best gains. The recession of 1969 and 70 was different because it introduced a new phenomenon that economists called stagflation. Inflation and unemployment rose simultaneously, which the economic models of that era said was impossible. The conventional wisdom was wrong. I learned from that recession to be skeptical of economic models and expert consensus. The experts assured everyone that inflation and recession could not coexist. Then they did. The experts are often wrong at precisely the moments when being right matters most. Trust your own analysis over expert opinion. The recession of 1973 and 74 was the most severe since the Great Depression up to that point. An oil embargo quadrupled energy prices. Inflation soared to double digits. The stock market fell nearly 50%. The Nifty 50 collapsed. Confidence in equities evaporated. But that brutal bear market created some of the best buying opportunities of my career. I bought shares in the Washington Post company when it was selling for about $80 million total market value, even though the company owned properties worth $400 million or more. The market was pricing in permanent disaster that never came. The lesson was simple but profound. When fear is at maximum, opportunity is at maximum. The best time to buy is precisely when it feels worse to buy. That is counterintuitive and emotionally very difficult, but it is the truth. The double-dip recessions of 1980 and 1981 through 82 came from Federal Reserve Chairman Paul Volcker's aggressive campaign to break inflation. Interest rates rose to 20%. Businesses could not afford to borrow. Unemployment soared above 10%. It felt like the economy might never recover, but Volcker's painful medicine worked. Inflation was broken. The stage was set for the extraordinary bull market of the 1980s and 1990s. Investors who bought quality businesses during that period of maximum pain were rewarded beyond their dreams. I learned that sometimes short-term pain is necessary for long-term gain. Policymakers sometimes have to make difficult choices that cause immediate suffering to prevent even greater suffering later. Investors should not fight the Fed, but should understand what the Fed is trying to accomplish and position accordingly. The recession of 1990 and 91 was triggered, partly by the savings and loan crisis, and partly by an oil price spike after Iraq invaded Kuwait. It was relatively mild compared to prior recessions, but still created opportunities for patient investors. What I remember most from that period was how the real estate market collapsed in many areas. Commercial properties that had been bid up during the 80s, boom, became available at tremendous discounts. I bought a property near New York University in 1993 that had been marked down substantially from its previous price. The location was excellent, the tenant base stable, the price attractive. It remains a good investment today. The lesson was that different asset classes are affected differently by different recessions. In the early 90s, stocks held up reasonably well, but real estate was devastated. In other recessions, the pattern was reversed. Diversification across asset classes provides protection that diversification within a single asset class cannot. The dot-com recession of 2000-2001 was unique because it was concentrated in technology stocks while the broader economy suffered only mildly. The Nasdaq fell nearly 80% from its peak. Trillions of dollars in paper wealth evaporated. Companies that had never earned a profit but were valued at billions of dollars went bankrupt. I had largely avoided the technology bubble because I could not understand the valuations and did not see how many of these companies would ever make money. My approach was criticized as old-fashioned and out of touch. I was supposedly missing the new paradigm. Then the paradigm collapsed. The tortoise beat the hare once again. The lesson was to stay within your circle of competence and not be seduced by speculative manias just because everyone else is getting rich. If you do not understand how a business makes money and will continue making money, you should not invest in it regardless of what the stock price is doing. The Great Recession of 2008 and 2009 was the most severe financial crisis since the Great Depression. Major financial institutions failed or required bailouts. Credit markets froze completely. The stock market fell more than 50%. It genuinely felt like the financial system might collapse entirely, but it did not collapse. Government action, imperfect as it was, prevented the worst outcomes. The economy stabilized and eventually recovered. Stocks rebounded powerfully. Investors who held on and kept investing were rewarded handsomely. I learned several lessons from that crisis. First, the government will act to prevent complete systemic collapse. Second, that government action creates both risks and opportunities that investors should consider. Third, even the worst crises end eventually. Fourth, maintaining liquidity during a crisis is invaluable because it allows you to be a buyer when everyone else is a forced seller. The pandemic recession of 2020 was the strangest recession I have ever witnessed. It was caused by a deliberate shutdown of economic activity to prevent the spread of disease. It was extremely brief, lasting only 2 months officially. The stock market crashed and then recovered in record time. The lesson from that recession was humility about prediction. Nobody predicted a global pandemic would shut down the world economy. Nobody predicted the speed of the recovery. Nobody predicted that stocks would reach new highs within months of the worst crash in decades. We cannot predict what will cause the next recession or when it will come or how severe it will be or how quickly recovery will follow. We can only prepare for the reality that recessions will come and position ourselves to survive and thrive. Each of these 13 recessions was different in its causes and characteristics. Each required slightly different responses, but the fundamental principles remain consistent across all of them. Maintain liquidity so you can act when opportunities arise. Own quality businesses that can survive economic stress. Think long-term and ignore short-term fluctuations. Be greedy when others are fearful. Make your decisions based on value, not on emotion or crowd psychology. Those principles worked in 1953 and they will work in 2026 and they will work for as long as markets exist. Let me also share what I will be watching as we move into 2026 and how you might think about monitoring conditions in your own portfolio. I will be watching valuations closely. Not because I expect them to predict the timing of any correction, but because valuations tell us about the margin of safety in current prices. When valuations are high, expected returns are lower and risks are higher. When valuations are low, the opposite is true. The current environment is one of elevated valuations by most historical measures. I will be watching corporate earnings. Profit margins are currently at historically high levels. If margins begin to compress due to rising wages, increasing competition, or changing economic conditions, stocks could decline even without a recession. Margins are mean reverting over time, and we may be due for some mean reversion. I will be watching credit markets. The availability and cost of credit often provides early warning of economic stress. When lenders become nervous, they pull back on lending. That pullback can trigger a cascade of effects throughout the economy. Credit spreads, which measure the difference between corporate bond yields and treasury yields, often widen before recessions become obvious in economic data. I will be watching consumer behavior. The American consumer is the engine of our economy. When consumers are confident and spending, businesses thrive. When consumers pull back, businesses suffer. Consumer confidence surveys, retail sales data, and credit card spending patterns can provide early indications of changing sentiment. I will be watching the actions of corporate insiders. When the people running businesses are buying their own stock, it often indicates confidence in their company's prospects. When insiders are selling heavily, it may indicate concerns about the future. Insider activity is not a perfect indicator, but it provides useful information about how those closest to the business view its prospects. Most importantly, I will be watching for opportunities to deploy the capital we have accumulated. The whole point of maintaining large cash reserves is to be ready when attractive opportunities arise. Those opportunities can come suddenly and disappear quickly. Being prepared means staying informed about potential investments even when you are not actively buying. For individual investors, I would suggest a simpler monitoring approach. Check your portfolio allocation periodically to ensure it still matches your risk tolerance and investment goals. If stocks have risen substantially,
They may now represent a larger portion of your portfolio than you intended. Rebalancing can help maintain appropriate diversification. Review your emergency fund regularly. Make sure you still have adequate cash reserves to handle unexpected expenses without selling investments. As life circumstances change, your emergency fund needs may change as well. Assess your income stability. If you work in an industry that tends to suffer during recessions, you may need larger cash reserves and more conservative investments than someone with very stable income. Your job security affects how much investment risk you can prudently take. Consider your time horizon. If you need money within the next few years for a specific purpose, that money probably should not be invested in stocks regardless of valuations. Short-term volatility can be devastating if you need to sell at an inopportune moment. Only invest in stocks with money you truly will not need for many years. Finally, consider your psychological makeup honestly. Some people can watch their portfolio decline 50% and sleep soundly, knowing that long-term fundamentals remain intact. Other people cannot tolerate even modest declines without becoming anxious and tempted to sell. Neither temperament is right or wrong, but you must know yourself and invest accordingly. The coming years will bring both challenges and opportunities. I cannot tell you exactly what form they will take or when they will arrive, but I can tell you that preparation beats prediction every time. I have survived 13 recessions. Each one taught me something valuable. Each one reinforced the same fundamental lessons that I now share with you. Stay liquid so you can act when others cannot. Stay patient and resist the urge to do something just because you feel you should. Stay focused on quality businesses that will survive and thrive. Be greedy when others are fearful, and fearful when others are greedy. Those lessons will serve investors in 2026, just as they have served me since 1953. The specific tactics may vary with circumstances, but the underlying principles are eternal. Apply them wisely in your own life. Prepare thoroughly before the storm arrives. Execute with discipline when lesser investors panic. And remember above all else that the greatest opportunities in investing come precisely when everything seems darkest and hope seems most distant. The next great opportunity is out there somewhere, waiting for those with the resources and the resolve to seize it. I fully intend to be ready when that opportunity arrives. I hope you will join me. That is my 2026 strategy. That is the accumulated wisdom of 94 years and 13 recessions and 75 years of daily dedication to understanding businesses and markets. The rest, my friends, is up to you. I have tried to share everything I have, learned from 13 recessions and more than 7 decades of investing. I have tried to explain not just what I am doing, but why I am doing it. I have tried to provide principles that any investor can apply regardless of their wealth level or sophistication. The fundamental truth is this: markets are unpredictable in the short term, but remarkably consistent in the long term. They will fluctuate, sometimes violently. They will test your resolve and your patience. They will make you doubt yourself and your strategy. They will tempt you to abandon your principles at precisely the wrong moment. But if you maintain your discipline, hold quality investments, keep adequate reserves, and think in decades rather than days, you will almost certainly do well. Not every year, not every quarter, but over a lifetime of investing, the odds are overwhelmingly in your favor. That is what I have learned from 13 recessions. That is my strategy for 2026 and all the years that follow. May your investments prosper, and may you have the wisdom and courage to hold on through whatever storms lie ahead.